Hello, everyone. Here we are all the way up to day 9. All right. And so today we have two big topics that we want to talk about. We want to talk about sovereign debt crises and what happens when governments can no longer borrow in bond markets and how that impacts financial systems. And so, well, this is really a question about bonds. It's also, I think, very closely tied to the nature of banking in ways that we're going to talk about here today. So, I'm going to talk about sovereign bond or sovereign debt crises, and then we're also going to talk about econometrics and regression analysis. And this is really to get you prepared for the quantitative reasoning part of the course and homework number 3. All right. So let's jump in here and begin talking about sovereign debt crises. And this is from your readings from my book from 2013 about financial systems and emerging market economies. All right. And so if you ordinarily took this class, we would have spent a lot of time. Oops, this is not what I meant to pull up. Yes, we would have spent a lot of time talking about this book that I wrote about financial systems and emerging market economies. This is one of the things that I kind of cut out a lot, given that we're teaching the course online and trying to keep the material a little bit more manageable. So anyway, the reading that you had was from my book, and specifically about sovereign debt crises or debt crises, right? So sovereign debt crises have to do with government bonds and when governments can no longer issue bonds in the market. Government bonds, as we've talked about, are obviously a very, very important financial asset for every aspect of financial systems, not just for bond markets, but for stock markets and how banks operate, right? Government bonds are a means of saving, right? They are a very attractive way in many countries for people to save. Government bonds provide a benchmark interest rate, right? We talk about the risk-free interest rate, and that risk-free interest rate is usually the T-bill rate, right? Kind of gives us an idea of, what a baseline interest rate or a benchmark, right? What's the interest rate under which other interest rates should benchmark to? And then finally, government bonds are important because they're a means of smoothing government spending and taxation, right? You think about how much different the economic effects of the coronavirus would be if the government didn't have the ability to borrow when they need to borrow, right? And so this ability that when taxes are going to fall because of the economic slowdown, but the needs for government spending go up, this ability to kind of be able to meet both of those things, to accept lower taxation at the same time that we spend more, that's a huge value in governments having the ability to issue bonds and borrow. Now, one question you might ask is, why do governments ever have to pay it back? And we'll talk about that. But, one of the reasons why governments have to pay it back is because they want to continue to borrow, right? And so if you don't pay it back, then it might impact your ability to borrow in the future. Before we talk more, though, about why governments have to pay it back, let's talk about two types of debt: domestic debt and foreign debt, right? Because it's important to make a distinction between these two. Domestic debt is debt that's issued in the domestic currency, right? So when the US issues a government bond denominated in dollars, that is domestic debt. Or when England issues a bond denoted in pounds, that's domestic debt. Domestic debt is typically held by domestic citizens. And of course, if you default on it, you're often making your own citizens mad, right? And so oftentimes defaulting on your domestic debt, one of the reasons why governments want to pay their bonds back is they don't want to make their citizens mad, right? And then also it could trigger a bigger financial crisis, right? We know that banks hold a lot of government debt. And so if you default on this debt, you could be putting banks in danger of going bankrupt. And so that's obviously creates a huge incentive for governments to pay back their domestic debt. Foreign debt is debt that's issued in a foreign currency, right? So many countries, because they simply don't have big enough domestic bond markets, have to borrow in a foreign currency such as dollars, right? So you think about a small South American country, let's say Uruguay, right? Yes, Uruguay can issue some domestic debt, and to be repaid in Uruguayan pesos. But if they need to borrow more than that, they're likely going to have to go to foreign investors. And those foreign investors are going to want to borrow, or they're going to want to be paid back in dollars. Now, you might say, well, doesn't that just encourage a government then to default on this debt? Because in this case, they're not defaulting on their citizens, they're defaulting on foreigners. And who cares about them? Well, once again, the problem is if you default on foreigners, those foreigners are not going to come back to lend to you, right? Foreigners can also freeze your assets, right? They can try to make life miserable for you. Argentina has defaulted in many times on its debt. And so many creditors have actually gone through legal systems in many, many countries trying to essentially put holds on Argentinian government assets. So for instance, the last I heard, the Argentinian president was still flying commercial airlines, not the government jet, to go visit Europe. Why? Because they were worried that if you flew the Argentinian government jet to visit Europe, the private plane, that as soon as they landed, somebody would seize it. So, that creates a pretty big incentive to pay back your debt, right? Even though it's a little bit easier to avoid paying foreigners, it's not easy to avoid paying foreigners. In the past, actually wars were fought over government debt, right? Egypt, what year was that? 1940 something, I can't remember the exact year, but basically defaulted on debt to England related to the Suez Canal. And England essentially, it wasn't in the 40s, it was much earlier than that. But anyway, sorry, I'm showing a little ignorance of my history here. Basically, England came over and took over the Suez Canal and essentially started a war with Egypt, right, over this idea of not paying your bills. So luckily that doesn't happen, but much anymore, but it could. I have one article that I put in your handouts, but here's actually an article about American creditors are demanding that China honor pre-communist debt. So these are government bonds that were issued back in the 1920s, right, by a government that preceded the Chinese Communist government, right? And so these creditors are still suing the Chinese government, trying to get them to pay off the debts of a previous government. It's unlikely that China's government is going to pay these, but it's a mess, right? It's a mess, and governments hate to be hounded by these kind of creditors. So yeah, there's a lot, even though the system of repaying foreign debts is not perfect, right? In other words, it's hard to get governments, or it's hard for foreigners to make governments pay their debt. There are avenues by which you can essentially make life miserable enough. And so, yeah, there's a lot of incentive for governments to repay their debt. Having said that, debt crises are pretty common throughout history, right? According to this study by Reinhardt and Rogoff, there are many, many serial defaulters, right? France defaulted on its debt eight times between 1500 and 1800. Spain 7 times before 1900. Nigeria 5 times since 1960. Argentina, I believe, is at 4 times since 1990. So, default is fairly common, and this is kind of counterintuitive, but default on domestic debt is actually more common than default on foreign debt. So, you wouldn't necessarily expect that to be true, but that is actually the case. How does debt impact the government's cash flow, and how do we understand how a debt crisis comes about? Like how do we get to a point where a government can't pay their bills? So the best way, I think, to understand this is to understand what's called the net transfer equation. And this is really looking at, does government debt add to your cash flow or take away from your cash flow, right? And so the net transfer here, meaning the amount of flow that's created by government debt, is really a function of 3 things. First, it's a function of the level of debt that you have. It's a function of G, which is the growth of debt, meaning how much new debt you're issuing, and R is the interest rate that you're paying on this debt. Right? So if you think about what this equation is saying, it's saying if you issue more debt, right? Like let's say that you grow your debt at 5%, but you're only paying 3% interest rate, you're actually going to have an inflow of funds. In other words, the net transfer is going to be greater than zero. And so this is usually what happens during a boom. During a boom, governments find it relatively easy to issue debt. G is greater than R, and so governments are able to create a lot of inflow, right? So when G is greater than R, you get a net inflow, right? NT is greater than zero. But what happens then when investors begin to get worried, right? And that's the crisis part of this. There's some sort of loss of confidence, right? Markets begin to worry, maybe the government can't pay this money back. Maybe they can't make future interest payments. Then there's a sudden stop. And a sudden stop means all of a sudden the government can't issue any new debt. G goes to zero. And because there's an increase in risk associated with holding government bonds, interest rates begin to rise, right? So R goes up towards infinity and G goes down towards zero. All of a sudden, the net transfer created by government debt is negative. In other words, this is becoming a drain on the government's finances. Now the government can't make debt payments and it becomes a vicious circle, right? They can't make debt payments, so that it becomes even harder for the government to borrow. Interest rates go up even more. The net transfer gets worse, and on and on and on, as I said, in a vicious circle, right? So in practice, this can happen, and you might say, well, what is it? What is the trigger, right? When does this sudden stop occur? And, honestly, it's very, very difficult to, in many cases, find an obvious trigger, right? It's very, very difficult. There is no kind of magic number. For instance, if debt gets to 100% of GDP, that doesn't mean you're necessarily going to have a debt crisis. Or if debt gets to 150% of GDP, you may not have a debt crisis. Really, when you have a debt crisis has more to do with psychology and confidence. And that's what we call debt tolerance, right? How much debt can you accumulate without a loss of market confidence? And this really has, as I said, this has a lot to do with psychology, but the psychology is based on perceptions, right? First off, what's the government's ability to repay? And a lot of this has to do with having a strong economy and economic stability. What's the government's history of repaying, right? Do they have they established a reputation for paying their bills? And then there's kind of the willingness to pay, right? What does the political situation look like in the country? Are there institutions that encourage repayment? So, listen, I think people have understood that the amount that you're able to borrow always, in every case, has a lot to do with confidence and trust, right? Alexander Hamilton, way back when we think about the Revolutionary War, Hamilton argued that the new government, right, should pay the debts of the Revolutionary War, of the revolutionary government, right? And at the time, many politicians were saying, oh, why don't we just repudiate all that debt that we incurred during the war? And now that we have a new government, start anew. And Hamilton said, it doesn't work like that. If we repudiate all the debt from the Confederate government, or not the Confederate, but the Continental government, it's going to be harder for the new government to borrow, right? We need to pay our bills to establish a reputation of paying our bills and establishing some debt tolerance. And so the US government has never defaulted on any of its debt. And that's obviously one of the things that helps us borrow today, right? Helps us borrow today. In practice, whether a government can borrow more money often comes down to this question of whether the problems they're suffering from is one of illiquidity or insolvency. Insolvency has to do with, does the government have even enough growth to be able to pay their debt, right? Insolvency is a more fundamental problem of the economy is just in such a mess, the government's never going to be able to repay their debt, as opposed to illiquidity, which could be a more temporary problem, right? A temporary problem, such as maybe a banking crisis or maybe a war, right? Or something that has the possibility of getting past very quickly, or possibly a pandemic, right? Government markets are probably more likely to lend money to governments during a pandemic than they would during, for instance, a political crisis, because the political crisis might portend long-term insolvency for the country, as opposed to a pandemic, which might more likely be temporary and just be an illiquidity problem. But if you actually look at the data, you can see that there's almost no relationship between what a country's debt level is and how likely they are to suffer a financial crisis, right? 16% of debt crises occurred when the debt to GDP ratio was greater than 100%, but 20% have occurred when it's less than 40%. Right? Japan currently has a debt to GDP ratio of 220%. Nigeria has a debt to GDP ratio of about 20%. I would make the argument that it's Nigeria that's more likely to suffer a debt crisis in the future, right? One of the reasons why Japan has such high levels of debt to GDP is they have so much debt tolerance, right? And so, kind of counterintuitive, the more debt you have might actually mean the less likely you are to have a debt crisis, because it means markets accept or have confidence that you can pay your money back. What can governments do during a debt crisis, right? Do they have any options? Yeah, they have a number of options, and often governments do kind of deal with this in multiple ways, right? So oftentimes it's a little bit of all five of these things that governments do. One thing they can do is they can just outright repudiate their debt, meaning they default, they just don't pay. But of course, the problem with this is that this leads to probably a long-term cutoff of being able to borrow money. And that's very, very costly to governments. So in practice, this happens maybe less than you would think, because governments really, really have big incentives to try to pay their debt. More likely, what governments try to do is they try to reschedule their debt. In other words, they meet with all their bondholders and they try to negotiate a settlement in which bondholders take a portion of their money back, and maybe at lower interest rates, but they get something, right? So in other words, usually what happens is countries ask investors to take what's called take a haircut. Taking a haircut means instead of getting 100% of your money back, take 50% of it back. And you might say, well, why would a bondholder agree to that? Because getting 50% of your money back is better than getting none of your money back. Right? So it might be better to reschedule than to push the country into an outright default. The problem with this is that you have to, basically the government has to agree with every single bondholder. We don't have a mechanism by which all bondholders can agree to reschedule at once. And so there's a big coordination problem. And in fact, a lot of bondholders purposely don't hold out. They'll say no always, in the hope that everybody else will take a deal, and then they'll be out there still able to maybe get 100% of their money by pestering the government long enough, right? And these are what us often call debt vultures. And with Argentina, that's exactly who's trying to seize all these Argentinian assets, is these debt vultures, right? These are people who have never agreed with Argentina on rescheduling their debt, and they just figure out we're going to be a big enough pain in the ass to Argentina until they pay us all the money back. It's not a very efficient system, quite honestly. So yeah, it's harder than it should be for governments to reschedule. Of course, almost certainly, governments are going to have to engage in some austerity, meaning they're going to have to cut government spending and raise taxes. Here's the problem with that. This is almost always going to worsen the economic crisis associated with this. It's hard to cut your way out of a crisis. this is exactly the opposite of what we think of as the Keynesian approach to dealing with a recession, right? Usually when you have a financial crisis, like even what we're doing right now, the government's cutting taxes and raising spending. Here you're asking them to cut spending and raise taxes and to essentially slow the economy down even more. So, there's this real question of how do you ever restore confidence in a debt market by running the economy deeper into the ground? And so, I think more and more countries often have to agree to some level of austerity. I think more and more that it's become clear that austerity in and of itself is not going to stop a financial crisis. Oftentimes you can get a bailout. The government can get a bailout. In other words, if markets won't lend to the government, maybe they can go somewhere else to get a loan, maybe from the International Monetary Fund. And this is the job of the IMF. The IMF basically has its members contribute money, and the IMF lends that money to countries that are in need. And so if you have a debt crisis, it's possible that you can get a loan from the IMF. Of course, the IMF is not just going to shell you out a big amount of money. Usually they're going to ask you to do things. And usually the IMF is going to say, you're going to have to work on rescheduling your debt, and you're also going to have to take some austerity, right? Increasingly, the IMF has been helping countries do two and asking them to do less austerity. But you're probably going to have to do a little bit of both. Or you can go to other interested parties, as we're going to talk about here in a minute with the Greek debt crisis. Greece basically owed a lot of Germans held Greek bonds, and so Greece went to Germany and said, "Hey, lend us money. If you don't lend us money, we're going to default on the bonds that you hold." So there's always possibility you could go to other governments or other interested parties to also maybe get a loan. Finally, an option, and this is a particularly effective option for reducing the debt, is to inflate, right? In other words, have your central bank just buy up the debt by printing up money. As I said, this is a very effective option for reducing your debt. However, it's also a very effective way of reducing your financial system to rubble, right? There's no better way to crush banks than through inflation. And there's no better way to destroy wealth than through inflation. And so while you can get rid of the debt problem, you're often going to lead to other financial problems and banking problems. And so we'll talk about hyperinflation a little bit later, but there's a long history of hyperinflations, particularly if you think about post-war Germany, post-World War I Germany, when Germany was beset with all these reparation payments from England and France. And so Germany couldn't pay it. How did they pay their bills? They just inflated, right? And this inflation ruined their financial system. It destroyed, huge percentages of the country's wealth. And it also set up the economic conditions and political conditions under which Hitler came to power, right? So, inflation is a good way to reduce the real value of your debt, but it can have other negative consequences. What are the consequences of the debt crisis, right? Well, if we look at history, you tend to see lots of variability between countries. Some countries have gone through debt crises and not had big effects. Other ones have had disastrous economic collapses. But typically we see a recession where GDP falls. We tend to see asset prices fall. So for instance, you'll see bonds and other stocks begin to fall. You'll see unemployment rise. Oftentimes there's a currency crisis associated with this, and we'll kind of talk about that link later. You'll see interest rates rise. You can see banking crises, right? So having a sovereign debt crisis is not good, right? Do banking crises lead to debt crises or vice versa? And the answer is yes, right? In history, we've seen examples of both of these things happen, where countries have had banking crises that have triggered debt crises, and also countries that have had debt crises that have triggered banking crises. First off, let's think about examples where there is a banking crisis that triggered a debt crisis. How would this work? Well, this would be if you have a banking crisis that needs a huge bailout from the government, and that bailout is so big that it then triggers a loss in confidence that the government can pay its debts. We saw a good example of this in 2009 with Ireland, right? Ireland had a very similar to the US, had a big housing bubble and a lot of mortgage-backed securities. When the housing bubble popped, many banks were holding these mortgage-backed securities. But Ireland basically said they were going to fully bail out banks. That ended up being more than 100% of GDP, and the Irish government never got that money back. Unlike what happened in the US, where we got almost all the money back, in Ireland, they never got the money back. That was such a big jump in debt that it then caused markets to freak out, right? And triggered a sovereign debt crisis. The good news for Ireland was this is an example of a illiquidity problem, in that the Irish economy was basically pretty strong. The rest of the Irish financial system was pretty strong. And so while this was kind of a temporary problem, Ireland was able to get a bailout from the rest of Europe, and its economy actually bounced back, and it's doing pretty well right now. The opposite case, which we're going to talk more about here in a moment after we break for a second, is when a debt crisis leads to a banking crisis. And this is more what happened in Greece, right? We're going to talk about the Greece case in more detail. But for Greece, they had a debt crisis. Their government was spending too much money. And when the markets lost confidence in Greek bonds, banks were stuck with large losses, and not just Greek banks, but banks throughout Europe. So what we see here is that, yes, a banking crisis can lead to a debt crisis can lead to a banking crisis. Right? So let's take a break here. This will be the end of section 1. We'll come back in the next section and let's talk a little bit about the European debt crisis and what happened with Greece.